As I record today's video, the stock market is closing at all-time highs almost on a daily basis. And you know what? It's an exciting time to be an investor. We open up our 401k statements and we think, oh my gosh, I can't believe my account is up this much in just 1 month. But it's also a dangerous time. You've heard the phrase, investors get hurt because they buy high and they sell low. And I don't know if the market's at a high, but one thing I do know for sure, the market's not at a low. And I don't want to see you get hurt. So in today's video, I'm going to share with you some strategies that you can benefit from and hopefully be able to retire early by doing these if the opportunity presents itself. But before we go there, I have to share with you 3 truths that are super important in order to be able to execute this strategy. So let's start there. Okay, truth number 1 is, unfortunately, humans suck at investing. You know, this is what I do for a living, right? And it takes a lot of discipline in order to not do the things that humans have evolved into doing, right? We've evolved into chasing attractive things and running away from scary things. We see a nice juicy apple up in the tree, we want to go get that juicy apple. We see a line 50 yards away, we want to get as far away from that line as quickly as we can, right? So that's greed, right? The apple, it's the greed, and it's fear of the lion. And unfortunately, those very helpful natural human instincts really, really hurt investors. And don't believe me? Let me show you a study here. This is done by a group called Dalbar, which is a third-party think tank. And they analyze how average investors do managing their investments. How do they get this information? They have access to our 401k data and our trading data, and they can see, okay, this is the world that people had to choose from, the investment alternatives, and here's how the average investor did. So here's a summary of that. So you can see here, and this is a 30-year study, so this is over a 30-year period. 1993, this study ended at the end of 2022. So during this period, inflation was 2.5%. You can see what the U.S. Treasury, what I would call the risk-free rate of return was, just a little over inflation, about 2.75%. And you can see what the average equity investor did, right, which is 6.8%. And you're thinking, hey, that's not so bad. We as humans are pretty good. But look at the next chart. 9.65% is what the S&P 500, let's just call that the stock market. That's what the stock market's done. So, and you might think, well, it's okay. We almost did 7% a year. And yeah, the market did a little better than us, but so what? Well, look at the next chart. If you started off that 30-year period with $100,000, with inflation, that would be about $210,000. If you put that in risk-free treasuries, you're going to have just under $225,000. And the average equity investor, almost $750,000, $750,000. That sounds pretty good. But look at this. Here's what that would have been had they just gotten what the S&P 500 did. Almost $1.6 million, so double. So investors gave away half of their return, and Dalbar calls this, and I call it the same thing, the investor behavior penalty. And what they mean by behavior penalty is the cost that our emotions cause us. So that's truth number 1. And unfortunately, we fight that truth. But I've been a financial advisor now for over 20 years. I've helped guide hundreds of people successfully into retirement. And I can tell you one of the keys for your success is just to acknowledge and accept the fact that left to our own devices, we as humans suck as investors. If you use that as a baseline, it doesn't mean you can't improve. But I think having that as a baseline is super important. Okay, truth number 2 is what really hurts people is not that they didn't pick the winning stock, but that they became what I call a forced seller in a down market. What do I mean by that? If you invested and you were fortunate and you got the best company in the stock market. Yeah, that's going to make a big, big difference in your life. But most of us are not going to do that. Find that needle in the haystack. So, let's say we have 100 stocks and, we didn't pick all the companies in the top quartile of that. Well, that's not going to hurt us. That's going to hurt us, but not so much as long as we get the median. If we basically get what the stock market did. But what does hurt us and what sets us back and really destroys wealth is when people sell at market lows. Something scary happens and they feel a lot of mental pain. I call it loss aversion. And, there's a difference between the word worrying and anxiety and anguish. Anguish implies a level of intensity that's 10x what worrying is. And it's the anguish that causes us to ourselves to voluntarily sign up and say, I want to be a forced seller in a down market. And I'm a forced seller because I want that emotional pain to stop. So getting this right and making sure you don't become a forced seller in a down market. There's really two reasons people become forced sellers in down markets. One I've talked about, which is the emotional pain, the anguish, the anxiety that they're feeling, and just the need to make it stop. Think back to 2008, 2009. I should say, too, if you weathered the storm in 2008, 2009, most of my viewers are in their 40s, so they remember that period. If they weathered that, congratulations. If you weathered the first 2 months of COVID, when the stock market had its steepest, quickest decline ever in stock market history, congratulations on that. But it doesn't mean that you're not going to become a forced seller in the future. I don't want you to be lulled into a false sense of confidence. So I said, the number one cause of becoming a forced seller in a down market is our own mental pain and the desire to make that stop by getting rid of our stocks, by selling those stocks. And we tell ourselves, well, the market's going to keep going down and I'm going to buy in lower. You know what? I've been doing this a long, long time. I've seen very, very few people ever buy in lower. More likely, the market's going to have some of its strongest days. And you're going to end up buying in later or chasing it, or even worse, staying out of the market for years. So that's the first reason. The other reason is just because people need cash, right? If you're retired and you need money for your living expenses, right, which is what we do. That's why we save money so we can spend it in retirement. But, most people are not going to be 100% in the stock market. They're going to have an allocation to bonds and an allocation to stocks. And if you have bonds that are maturing to meet your cash flow needs, then you don't have to sell your stocks. But if you don't have that, you're going to be a forced seller. Another way people get bit by becoming a forced seller is when they have debt. Maybe they have debt that's coming due. They took out an extra loan on their house, and that loan is coming due in 3 years, 4 years, 5 years. And unfortunately, the timing's bad. And that money is due at a time when the stock market is low, right? That's another time. So those are the two main reasons for the second truth that I want to share with you. And then the third truth has to do with fear. And I'm going to have to give you a Will Smith quote, because Will Smith says it much better in one of his movies. Will says, fear is not real. It is a product of thoughts you create. Do not misunderstand me. Danger is very real, but fear is a choice. And that's the third truth, that fear is a choice. Scary things can happen, right? Danger is real. Scary things happen in the stock market. The ups and downs, the volatility of the stock market is a feature of the stock market. It's not a bug. It's inherent in the stock market itself. But how we react to that, that's a choice. So I love that quote. I'm going to say it again because I really like it. Fear is not real. It is a product of the thoughts you create. Do not misunderstand me. Danger is very real, but fear is a choice. So it's how we react to these things. So with those truths behind us, now let's jump in to what we can do to protect ourselves and maybe take advantage of any stock market correction that might happen in 2024. I'm going to share with you some really, I think, powerful information, but it's going to speak to your head. And somehow we got to get it from your head to your heart. But let me share with you some of this. How likely is it that you're going to be hurt by a stock market downturn? That's what I'm going to talk about for the next couple minutes. And I think if you plan properly, the likelihood of you getting hurt is very low. And if you have that mindset, then you can take advantage of market downturns. And for instance, in 2008, 2009, there were just some incredible buying opportunities out there. It was such a challenging time because we thought the financial markets might melt down, that while there were bargains out there, while prices had been cut in half, few of us were buyers. But I want to get you in the right mindset so that if the market does go down, you can take advantage of it. And this can move the needle for you, right? What hurts a lot of people is being that forced seller in a down market. But the flip side of that is if you're a buyer in a scary down market, you can do very, very well, okay? None of this is financial advice I should share. I don't know your situation. I don't know what's right for you. And I do suggest you work with a professional, but I want to share this so it's on your radar screen. It's something for you to be thinking about. Okay, so what's the likelihood of you getting hurt in a down market? First, I want to share some data here. So the likelihood of the market being positive or negative on any given day, let's say positive, is about a coin toss. About half of the time the market closes higher for the day than what it opened. It's actually 52.4% in favor of it being positive. In any 3-month period, about 2/3 of the time, the market's going to be positive for that 3-month period, which is 65.6% of the time. It's going to be positive. So dramatically better than a coin toss. In any 1 year, the market closes 3/4 of the time higher than where it started. It doesn't mean every year, obviously, is going to be positive, but the odds are in your favor. It's almost 3/4, 72.8%. And look at this, over 10 years, the odds are 95% in your favor. Over a 10-year period, the market is positive 94.2% of the time. Okay, so let me show this another way. This chart here shows the probability of getting a positive return based on how long you're in the market. And you can see here, the chart starts off right at about 50%, and it goes up from there, right? Basically, this is just a chart showing that data, but look, something magical happens. What is it, about year 11 or 12? It starts going up dramatically, and you can see it almost approaches 100%. Now, you might think it never approaches 100%, but you know what? It does. Stay with me. Okay, and not only does it approach 100%, but it gets to 100% and delivers a good number. So again, this is about danger. What is really the danger? Let's say you're 60 years old and you're going to retire, and you've still got 30 years in front of you. Now, you should not be, I shouldn't say this, most people, you need to talk to your own financial advisor. The vast majority of the people should not be 100% in the stock markets when they're 60 years old, even if they have a 30-year time horizon. Why? Because that anguish, that pain of loss aversion increases dramatically once you're no longer making money. And that's one of my jobs as a financial advisor for my clients, is to let them know that. They might have been 80, 90, 100% in stocks their whole life. They may have never been tempted to sell their stocks in the past, but doesn't mean that they're going to be able to stay the course in the future, because once you don't have that paycheck coming in, once you're not adding to your savings, once that nest egg is everything that you own, boy, the pain of loss increases dramatically. Okay, so let's go. I showed that chart that says it almost gets to 100%. This is kind of the opposite of the chart, but I think I want to show this because this shows the likelihood of having a loss during a period of time. So you can see, once you get out to year 13, it almost goes to 0%. It doesn't go to 0%. It looks like it does, but it doesn't. But you can see, in the first year here, the likelihood of a loss, is quite a bit higher than even if you go out 4 or 5 years. Okay. Again, I'm trying to explain the danger. What is the danger you're facing? Okay. So this is an S&P 500 rolling 10 years. So this is looking back 10 years. So as of the end of 2023, you go back 10 years. 2022, you go back 10 years and see what it is. And there's very few periods where over a rolling 10-year period, the S&P 500 has delivered a negative return. There are some, but there's very few of them. I do want to mention, because I think that's important, the SEC tells financial advisors, you have to tell your clients that past performance is not indicative of future performance. And there's a good reason that they tell us to tell folks that, is because it's true. It's absolutely true. Just because this is what's happened in the past doesn't mean it's what's going to happen in the future. But I think we can get some comfort knowing this is historically how things have gone. Stick with me, because I know we're getting a little in the weeds, but you're really going to like this last chart. The next chart shows 20-year rolling period. So over a 20-year period, I want you to notice something. There's not a single 20-year rolling period, including looking at the Great Depression era. If you had invested just before the start of the Great Depression, you still would have had a positive return. It would have been negative. This is over 20 years, but okay, here's the really exciting chart. And sorry, this is financial advisors getting excited about sharing something important. Okay, so this is the rolling 30-year returns. And what do we see here? Not only are there no negative returns over a 30-year rolling period, but the worst year, the worst 30-year rolling period, which was if you had invested right before the start of the Great Depression, you would have averaged 7.8% per year. And over 30 years, you would have got 10 times your money. So if you started with $100,000, you would have ended that 30-year period with $1 million. It would have been a really scary ride, and there's very few people that could have withstood that if there were 100% in stock. But so that's the worst case. And this is where the danger comes in. What is the danger? Truth is, I don't know what the danger is, but I can tell you historically what the danger has been. And the danger over a 30-year period has not been that great. Doesn't mean it's not going to be painful. Doesn't mean you're not going to be cursing your financial advisor's name during times like this. But it does mean that over the last, 80, 100 years? What do we got? We're going back to, this goes back to 1955. But you got to remember, that's the first rolling year period. So that goes back to 1925, right? Because the first 30-year, it took 30 years for that 1925 start date to have a rolling 30-year number. So it was 1955 when we finally had that data. So this is a fair amount of data on the U.S. stock market, okay? And the best time during that, and I'm not worried about the best, I'm worried about the worst. So the worst case, again, 7.8% a year. But just for kicks and jollies, the best case was almost double that, not quite. It was 14.8%. That period ended in 1968, probably around the time many of my viewers were born. And that delivered, if you had $100,000 in it, that was not a 10x return, that was a 60x. So you would have ended up with $6 million in the best case. Okay, so importantly, what do we do with this, right? We got the cute Will Smith quote that says, fear is a choice, but danger is real. Now Sol's been talking about what is danger for you. Okay, so what do you do? I think what we do is, job number one is protect ourselves from becoming a forced seller in a down market. How do we do that? We do that by getting our asset allocation right. What percent of your portfolio is in stocks? What percent of your portfolio is in bonds? And I want you to do that when times are good. For instance, like right now, when the stock market is printing all-time highs and there are not as many scary headlines and you're thinking clearly. The time to decide on your asset allocation is when you're thinking calmly and clearly, and hopefully with the help of a professional, and preferably somebody that's a fiduciary to you 100% of the time, whether that's a financial advisor or an accountant or a tax attorney that you might use. but work with a professional and somebody that has a fiduciary duty to you 100% of the time. Okay, so is that financial professional going to beat the S&P 500? I don't know, but that's really not why you hire him. You hire him to get him or her, to get the asset allocation rate. You hire her so that you can stay the course during scary times. You hire her to handle all the complexities that come with this. And, sometimes people will say, hey, so what does a financial advisor charge? In general, it's, 1 to 2%, somewhere in that range on a percentage of the fees. But here's the thing. If you lose 10%, let's say you hire somebody at 1%. If you lose 10% because you panicked or you had the wrong asset allocation of your portfolio, that's 10 years you could have had a professional by your side helping you out in dealing with all the complexities and the pain in the wazoo stuff. So I think a financial advisor is going to be super helpful. Obviously, I'm biased, but I think long term we add more value to the portfolio than what our fees would reflect. So I think it's not just the cost, but it's the value. Okay. And closing, I just want to remind you that the time to do the asset allocation, the time to get that right, so that when you call your financial advisor, so that when you look at the stock, you look at your 401k and it's not so fun anymore, and it's down 20, 30, 40%. It's down $100,000, which maybe took you 8 or 10 years of hard sacrificing and saving to get. When you look and things are scary and you're thinking, how am I protected? The answer to that is what you did or what you and your financial advisor did 2 years ago, 5 years ago. And if you can keep calm when all around you are losing their wits, that's when you can make a lot of money. That's when you can look at the bargains out in the street and say, you know what? Maybe I will go bargain shopping because I'm not so fearful. I hope this video has been helpful. I also hope this video up here is helpful, which talks about 5 reasons to retire as soon as you can. I hope you enjoy that video. Thanks for watching this one. Bye-bye.